Investors are coming back to the market in the middle of September and reacting quite strongly to a number of big headlines coming across. This is really kind of shattering the relative calm the market had enjoyed over the last couple of months, with the major averages kind of perched on very important psychological levels such as 2,000 on the S&P 500. The reason for this is there's a number of big catalysts in play, including the possible change in the Federal Reserve's policy statement on Wednesday as we move closer to the end of the QE3 bond purchase program and move ever closer to the timing of the first short-term interest rate hike. Now, this is a big deal because we haven't seen the Fed raise interest rates since 2006. So we're seeing some volatility spread from the bond market to other markets, including stocks, and investors are responding and kind of preparing for what could be a potentially volatile situation heading into the end of the year. This is kind of a big change because as researchers from the Bank for International Settlements and elsewhere have noted, the market had kind of settled into a very, very calm condition. If you look historically across asset classes, not just in stocks, but also in currencies and commodities and bonds, volatility, or the day-to-day jumps, the price changes you're seeing from day to day, had narrowed down so much so that we're kind of outside the range of historical norms. We're actually below the 10th percentile in most of these asset classes in terms of historic volatility, which means this is kind of as good as it gets in terms of calm market conditions. And as a result, we've seen investors become very confident with surveys of bullish sentiment compared to bearish sentiment, so positive versus negative sentiment, moving to levels that haven't been seen since 2004. So folks have been feeling pretty good, not seeing a lot of day-to-day jumps, kind of feeling comfortable with where they are. But as history suggests, such a low volatility condition is not going to last. We're going to see most likely return to historical averages.